approach to equity should be staggered investments currently. If there is a correction in the market, maybe around 10–15%, probably that is the time to look at it in terms of increasing the allocation. But otherwise, a staggered approach is good. So I think it's a guessing game overall in terms of equities have a good growth support, but at the same time they're expensive. Fixed income is safer, but returns are low. Gold, again, there is issues in terms of not from price or outlook standpoint, but from how do you buy it, right? So overall, if you think that you can't manage it on your own, probably multi-asset funds are a best way to do it. But what mistake many people do is have a multi-asset allocation and still again do the same asset allocation on their own. So you're duplicating your efforts. So choose the way you want to invest, either in a multi-asset fund or you want to build your own allocation. And if you see, there is clear merit of doing a multi-asset framework, right? See, equities, they have given long time frame since 2004, 13%, 13.2% annualized return. In a multi-asset framework, you do reduce your return, but look at the risk that gets reduced. The volatility, the up and down movement, goes down by from 20% to about 9%. Your risk, the fall that we saw in 2008, 56%, goes down to 21%. So that's something that helps you really when it comes to a multi-asset framework. You do compromise on some return potential, but at the same time, you lower your risk significantly. This is, again, the COVID example, right? If you had 100% equity, you fell by about 28% in that quarter, whereas if you had a multi-asset allocation, you fell by only 8%. So people do ask us in terms of, what allocation should we have over the long run? So we are set in our jobs. We just want to create wealth for various goals. How should we do it? And we think the simple answer, because many times people tend to complicate investing quite a bit. You should keep it simple. And if you want to keep it simple, this 12-20-80-12, 12, 80, 20 works really well for investors. Be it a bull run that we see, be it a bear market or like global financial crisis or COVID crisis that we see, you will be unmoved if you have this structure in place. Which says that 12 months of expenses kept very, very safe. For many investors, this can be higher. This can be 24 months, 36 months even. But keep something which is safe so that if something happens to your income, it does not impact you so much. And post that, whatever money you have, you split 80 into equities and 20 into gold. And in equities, you need to diversify across few styles, but you need to diversify. What many end up doing is, in equity portfolio, we have seen that many have 25, 30 schemes, and it's so much over diversification, you don't add up any additional return than the index.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.